Are you looking to sell your house or land or farmland? Make sure you watch this video before you go ahead with it. In this video, I will be sharing with you the different types of immovable property, the tax implication on sale of immovable property, the deductions available for reduction of capital gain, and lastly, as a bonus, a few tips for non-resident Indians. I am Yashwant Nijgal, a practicing chartered accountant. Every week, I post one video which will certainly provide you with valuable financial insights. So we can broadly classify immovable property into two categories. One is agricultural and the second is non-agricultural. Under agricultural land, you have your plantation, you have your farmland, and you have your farmhouses. Under non-agricultural immovable property, you have your houses, you have your apartments, you have your vacant land, and also commercial buildings. In addition to this, a property can be classified as a short-term asset if it is held for less than or equal to 24 months, or a long-term asset if it is held for more than 24 months. Let's now talk about the tax implication on sale of immovable property. So there are two broad categories. One is the agricultural land, where we all know that there are no taxes. Just make sure that you read through the terms and conditions mentioned in the description to get the classification right. And the second category would be the non-agricultural immovable property. Under this, you have long-term capital gain. That is, if you have held a property for more than 24 months and the rate of taxation is 20%. And if it is held for 24 months or lesser, the taxation rate would be the regular standard slab rates. So how do you arrive at the capital gain? On the one hand, you have the sale price, and the other, you have the cost of acquisition, which can be divided into three major categories. One is the purchase price of the property, and the second is the cost of improvement, and the third would be the cost associated with the sale. For example, say you have sold your apartment for 1 crore, which you had bought it for 40 lakh rupees and spent 20 lakhs on the interiors and 2 lakhs towards brokerage. Your net capital gain would be rupees 38 lakhs. Couple of interesting points to be noted. One is, in case of long-term capital gain, make sure you take advantage of the indexation benefit, which basically takes into account the cost of inflation. And the second, if you have purchased your property on a loan and you have not taken the benefit of interest paid on the housing loan, you can include the interest paid from the time of acquisition till the time of sale as part of the cost of acquisition. So once you arrive at the capital gain, you can avail deduction under section 54, which I will be covering in another video. And two, if the sale price is more than 50 lakh rupees, 1% TDS will be deducted by the buyer, and just make sure that you claim it at the time of filing your income tax returns. Now, as promised, a tip for the NRIs. So if you're a non-resident Indian, the buyer is ideally supposed to deduct tax at 20%. This is a really big disadvantage. So what you can do about it is get a certificate of lower tax deduction from the income tax assessing officer, wherein he will be allowing the buyer to deduct tax at a much lower rate depending on the actual capital gain. For more assistance, you can get in touch with your professional. And one last super benefit which you can take advantage of is with respect to properties purchased before 1/4/2001. Say you have purchased a land in 1989 for 5 lakh rupees. What you can do is get a valuation of the property done as on 1/4/2001 by a chartered engineer and consider that as the cost of acquisition. This way, the cost of acquisition can significantly increase, thereby reducing your capital gain tax. So to conclude, selling of a property can be seen as an avenue for better investments, and don't get bogged down by capital gain taxes. And as always, no tricks, no hacks. Follow me for valuable financial insights.